Your payslip lands in your inbox. Same job, same hours, same employer, but the number is different, not dramatically different, not the kind of different that makes you call someone, just different by 40, 60, maybe $90, enough that you notice, not enough that you understand why. You open the ATO website, you read 3 paragraphs, you close the tab, you open it again the next day and try a different page. You find a PDF that was last updated in February. You find a meteor release full of phrases like fiscal consolidation and targeted cost of living relief and staged implementation of personal income tax adjustments. You close that too. Here is the thing nobody tells you about the Australian tax system. It is not designed to be understood. It is designed to be administered. Those are two completely different things. And the gap between them, the gap between what the government changed, what it means for your actual life, and what anyone is clearly explaining. That gap costs Australians billions of dollars every single year in missed deductions, wrong withholding, and decisions made with incomplete information. The 2026 federal budget made real changes to how much tax you pay when you pay it and what you can claim. Changes that affect your payslip, your super, your side income, and your ability to build any kind of financial life outside of your salary. This video is going to explain all of it, in plain language, with actual numbers, in the order that matters for your specific situation, not the meteor release version, the version you actually need. Let's start with the thing that touches the most Australians first. The personal income tax thresholds in Australia have not kept pace with wages for most of the past decade. That is not an opinion. It is a mathematical fact called bracket creep, and it is the government's favorite way to collect more tax without ever announcing a tax increase. Here is how it works. In 2015, if you earned $80,000, you paid tax at a certain rate. If wages grew at 3% per year and your salary followed, by 2025 you were earning roughly $107,000. You did not get richer in any meaningful sense. You can't buy more groceries, afford a bigger house, or take a better holiday than someone earning $80,000 in 2015. You just kept pace with inflation. But the tax brackets did not move with you, so more of your income now sits in a higher tax bracket than it did before. The government collected more of your money. You never voted for a tax increase. There was no announcement. It just happened quietly every year, the way a slow leak empties a tank. The Stage 3 tax cuts that began in 2024 partially addressed this, but only partially. And the changes in the 2026 budget build on top of that foundation in ways that are genuinely significant for anyone earning between $45,000 and $135,000, which is most working Australians. Here is where the brackets now sit after the 2026 budget adjustments. $0 to $18,200 tax-free, no change. This has been frozen for years and remains frozen, which means the lowest income Australians get no bracket relief at all. If you earn under $18,200 from any combination of part-time work, casual work, or investment income, you pay nothing. That stays the same. $18,201 to $45,000, 19 cents per dollar on the amount over $18,200. This lower threshold has shifted slightly. The practical effect is that the first $18,200 is now a wider genuine tax-free space before the 19% rate kicks in for most workers with the low income tax offset applied. $45,001 to $135,000, 32.5 cents per dollar. This is the bracket where the most significant 2026 change sits. Previously, this bracket cut off around $120,000. Lifting the ceiling to $135,000 means that for anyone earning between $120,000 and $135,000, roughly $15,000 of their income that was previously taxed at 37% is now taxed at 32.5%. That is a 4.5 percentage point difference on $15,000. Real money. $135,001 to $190,000, 37 cents per dollar. This bracket has expanded. It now catches income between $135,000 and $190,000 rather than between $120,000 and $180,000. For very high earners, this is largely neutral. For people in the $120K to $135K band, it is a meaningful cut. Above $190,000, 45 cents per dollar. It does not make top rate as headlines because the dollar amounts look unchanged. Some levy of 2, but as percent applies on top of all of percentage, these have take rates home for payma for a part-time taxpayers. Now let me show you what this means in actual dollars, until if you are on a see the Tate part-time home income impact. Or you are $60, employment 000 a income year. Marginal under the rate and your previous LITO entitlement settings. Number of their people in this annual income tax bill was approximately dollar band or over 11,067. The 2026 changes settings, adjusted but only if you file your offsets, their tax bill falls to approximately $10 LL brings coming to A back to 388. That is $679 less per year. Now I about $13 per want to week, not something that life will affect far more changing but real. Someone earning $90,000 a year. Previous annual tax approximately $21,717. Under 2026 settings approximately $20,797. Saving of $920 per year, roughly $17.70 per week. Someone earning $120,000 a year. Previous annual tax approximately $31,867. Under 2026 settings approximately $30,117. Saving of $1,750 per year, about $33.65 per week. Someone earning $135,000 a year. This is where the change is most visible. Previous annual tax, approximately $38,167. Under 2026 settings, approximately $35,742. Saving of $2,425 per year, about $46.60 per week. Someone earning $180,000 a year. Previous annual tax, approximately $58,167. Under 2026 settings, approximately $56,342. Saving of $1,825 per year. The saving is lower than for the $135K earner because above $135,000, they are in the 37% bracket and the ceiling shift doesn't benefit them as much. The pattern here is important and not widely reported. The biggest proportional winners from the 2026 personal income tax changes are people earning between $110,000 and $145,000. Not the highest earners, not the lowest. The upper middle income band, which includes nurses in senior roles, teachers with 20-plus years of experience, tradespeople running their own operations, mid-level corporate workers, and dual-income households where both partners earn around $65,000 to $75,000 each. If that describes you or your household, the 2026 budget was actually more generous than the headlines suggested. The low-income tax offset and the low- and middle-income tax offset have a complicated history in Australian tax policy, and the 2026 budget changes them again in ways that matter. The LITO, the low- and middle-income tax offset, was a temporary measure introduced during the pandemic era to give a cash buffer to households under pressure. It was worth up to $1,500 and then it was removed, which caused a surprise tax hit for millions of Australians in 2022 and 2023 who had not realized the offset was ending. The 2026 budget does not bring back the LITO in its old form. What it does do is restructure the low-income tax offset in a way that produces a similar benefit at the lower end of the income scale. The LITO now provides a maximum offset of $700 for incomes up to $37,500. It then phases down between $37,500 and $45,000 and completely phases out at $66,667. This is not new in principle. The LITO has existed for years, but the 2026 adjustment lifts the maximum offset amount and extends the phase-out range, meaning more people get more benefit for longer as their income rises. What this means practically: if you earn between $25,000 and $40,000, the LITO adjustment in 2026 is one of the most meaningful tax changes in the budget for you. It does not make headlines because the dollar amounts look small compared to the changes at higher income levels. But as a percentage of take-home pay for part-time worker or someone working in a low-wage industry, an extra $200 to $400 in annual take-home is not nothing. If you are on a part-time income, a casual income, or you are a student with some employment income, check your marginal rate and your LITO entitlement. A large number of people in this income band are overwithheld throughout the year and receive a tax refund at return time. The 2026 changes increase the size of that refund for many people, but only if you file your return. Which brings me to a point I will come back to. Now I want to talk about something that will affect far more people than the income tax changes, and that almost no one understood when the budget was handed down. The Medicare Levy Surcharge thresholds. The Medicare Levy Surcharge is a penalty, not a tax, a penalty. It exists to push higher-income Australians who do not hold private hospital cover into buying it, thereby reducing pressure on the public health system. If your income is above a certain threshold and you do not hold an appropriate level of private hospital cover, you pay an additional 1%, 1.25%, or 1.5% on top of your normal income tax and Medicare levy. On a $100,000 income, that is an extra $1,000 to $1,500 per year going straight to the ATO. Every year. For years, these thresholds were frozen, which meant that bracket creep was pulling more Australians above the surcharge threshold even when their real purchasing power wasn't increasing. A person earning $93,000 in 2022 who got a wage increase to $97,000 in 2023 crossed the threshold and suddenly faced an MLS liability they hadn't budgeted for. The private health insurance premium they needed to avoid the surcharge cost roughly the same or less than the surcharge itself. But many people didn't realize this and just paid the penalty without understanding why their tax return was lower than expected. The 2026 budget has finally moved these thresholds. The base threshold, below which no surcharge applies, rises from $93,000 to $97,000 for singles. For families, the threshold rises from $186,000 to $194,000. The Tier 1 threshold 1% surcharge now applies from $97,001 to $113,000 for singles. The Tier 2 threshold 1.25% applies from $113,001 to $151,000. The Tier 3 threshold 1.5% applies above $151,000. These are meaningful shifts. If you were caught in the surcharge band previously because your income drifted just above $93,000 and you didn't have private cover, you may now be below the new $97,000 threshold and no longer face the surcharge at all. But here is the decision I want you to actually make after watching this video. If your income is between $97,000 and $130,000, you need to do the math on private health insurance right now. Not in theory. Actually sit down and do it. The cheapest basic hospital cover for a single person in Australia currently runs between $80 and $140 per month depending on your age, state, and insurer. Call it $110 per month. That is $320 per year. The MLS at the Tier 1 rate of 1% on $110,000 of income is $100 per year. At first glance, the insurance costs more than the surcharge. But the comparison is not that simple. Because private hospital cover also gives you access to shorter waiting times for elective procedures, your choice of surgeon, and a private room. For many people at this income level, particularly those in their 30s and 40s who are starting to think about joint replacements, investigations, surgeries they've been putting off, the cover has genuine practical value beyond just avoiding the surcharge. Additionally, if you take out private cover before you turn 31, you avoid the lifetime health cover loading. This is a 2% loading on top of your premium for every year over 30 that you do not hold hospital cover. Someone who takes out cover at 35 instead of 30 pays an extra 10% on their premium forever. Someone who waits until 40 pays an extra 20% forever. So the question is not just, is it cheaper to pay the surcharge or buy the cover? It is, what does waiting cost me over the next 20 years, both in health access and premium loading? The 2026 threshold change makes this decision newly relevant for anyone in the $93,000 to $97,000 band who has been paying the surcharge or who has been scrambling to maintain cover. You now have breathing room. Use it to make a deliberate choice rather than a reactive one. Super. Let's talk about Super, because the 2026 budget changes here are genuinely significant and will not affect your payslip at all, which is exactly why most people will miss them entirely. The superannuation guarantee, the percentage of your ordinary time earnings your employer must contribute to your Super, rose to 12% in 2025 and holds there in 2026. No change to the rate, but two other changes matter considerably. The first is the adjustment to the concessional contributions cap. Concessional contributions are the before-tax contributions going into your Super, your employer's Super guarantee contributions plus any salary sacrifice you make. In 2025, the concessional cap was $30,000 per year. In 2026, it rises to $32,500. That extra $2,500 in concessional space may sound modest. But remember, money going into Super as a concessional contribution is taxed at 15% inside the fund. If you're a $90,000 earner, your marginal rate is 32.5%. Every additional dollar you salary sacrifice into Super is taxed at 15 cents instead of 32.5 cents. That is a 17.5-cent saving per dollar on the difference. On $2,500 of additional concessional space, that is $437.50 in tax you don't pay per year for as many years as you maximize the cap before preservation age. If you are between 40 and 55 and you have not been maximizing your concessional cap, the carry-forward rules still apply. If your total Super balance is below $500,000, you can carry forward unused concessional cap space from the previous 5 years and make a larger concessional contribution in a single year. The 2026 budget did not change this rule, which means it remains one of the most powerful catch-up mechanisms available to Australians who had career interruptions, parental leave, or periods of reduced income. The second Super change is more targeted, but affects a specific group significantly. The Division 293 tax threshold, the point at which high-income earners pay an additional 15% tax on their concessional Super contributions, bringing their effective rate from 15% to 30%, has been adjusted. Previously, Division 293 applied to income above $250,000. The 2026 budget lowers this threshold to $220,000. If your income including reportable fringe benefits and reportable employer super contributions exceeds $220,000, any concessional contributions you make to super will now be taxed at 30% instead of 15%. This is important for two reasons. First, it changes the calculus of salary sacrifice for very high earners. At 30%, the benefit of concessional super contributions is much smaller, particularly when compared to investing in the name of a trust or company structure at different effective rates. Second, Division 293 assessments arrive after the fact through the ATO, sometimes creating surprise tax bills. If your income crosses $220,000, and this includes bonuses, investment income, and the grossed-up value of employer benefits, you should be setting aside funds to meet a potential Division 293 liability rather than being blindsided when your assessment arrives. Now I want to talk about the part of the 2026 budget that will affect the most people, generate the most confusion, and almost certainly produce the most incorrect tax returns filed this year: working from home deductions. The pandemic years changed where Australians work. The ATO's response changed how they are allowed to claim it. The 2026 budget introduced further refinements that make an already complicated area harder to navigate. There are currently two methods for claiming work from home expenses. The fixed rate method, 67 cents per hour worked from home. This covers electricity and gas, phone expenses, internet, stationery, and computer consumables. It does not cover depreciation of equipment, office furniture, or the occupancy costs of your home. The actual cost method, you calculate the actual additional costs you incur by working from home. You need records, diary entries, bills, invoices, receipts, and you need to calculate the work-related portion of each expense. The 2026 budget has not changed the 67-cent rate itself. What it has changed is the record-keeping requirement, and this is where people will get caught. Previously, the ATO allowed a representative period of records, essentially a 4-week diary, to extrapolate your annual working from home hours. As of the 2026 income year, this representative period approach has been tightened. The ATO now expects contemporaneous records for a much larger portion of the year for anyone claiming significant WFH deductions. What does this mean for you right now today? If you work from home any proportion of the time, you need a log, not a perfect log, not a detailed minute-by-minute account, but a genuine record of hours worked from home. Maintained through the year, not reconstructed at tax time. Apps work. A running note on your phone works. A spreadsheet that you update weekly works. What does not work is trying to reconstruct 8 months of WFH hours from memory in June because your accountant asked. The 67-cent rate, if you work from home 2 days per week for a full year, produces a deduction of roughly $1,400. That is not nothing, but it is only available if you have the records. Without them, your accountant cannot claim it, or can claim it and expose you to an audit liability. There is one more change in the 2026 budget that I think is genuinely underreported, and that will matter to a specific group: Australians with investment properties. The depreciation rules for investment properties have not been dramatically overhauled, but the ATO's compliance activity around property deductions has intensified significantly, and the 2026 budget allocated additional funding to a real estate investor compliance program that targets overclaimed deductions. The 4 areas the ATO is specifically scrutinizing for the 2026 income year are: interest deductions on loans where part of the loan was refinanced or topped up for personal purposes; travel expenses claimed as inspection visits that were in reality personal holidays to areas where the investment property happens to be located; repairs versus capital improvements, the distinction between a repair that is immediately deductible and an improvement that must be depreciated over years; and property manager fees claimed without evidence of actual property management activity. If you have an investment property, this is not a warning to stop claiming legitimate deductions. Every dollar of legitimate deduction is a dollar you are entitled to. What it is a warning about is the precision required. Your interest deductions must reflect only the investment portion of the loan. Your repairs must be repairs, not improvements. Your travel claims must be genuine, documentable, investment-related visits. The difference between a legitimate claim and an overclaim is often not intent. It is documentation. The ATO's new compliance activity means that investment property owners with correct claims but poor documentation will face the same scrutiny as those with incorrect claims. Get the records in order now before the income year closes. Let me now come back to the person at the beginning of this video. Same job, same hours. Payslip is different. Here is what actually happened to that payslip. If their employer has updated their withholding calculations to reflect the 2026 tax bracket changes, which they are required to do, the withholding will be slightly lower than before. Not dramatically lower, but lower. The income tax changes flow through as reduced withholding, which shows up as a slightly higher net pay. But here is the thing that frustrates me about how these budget changes get communicated. The pay slip number changes. No one explains why. People either don't notice or notice without understanding. They do not then go and adjust their voluntary super contributions in response to the new bracket, even though it may now make more sense to salary sacrifice given a changed marginal rate calculation. They do not check whether the MLS threshold change means they can safely drop private cover for now or finally justify taking it out. They do not look at the LITO adjustment and realize their partner who works part-time is entitled to a larger offset that affects how they should structure their family income. All of these decisions connect. The tax system does not operate in silos. A change to the income tax brackets affects the value of super contributions. A change to the MLS thresholds affects your insurance decisions. A change to the LITO affects whether one partner should work more hours or how to structure a business income split. The 2026 budget did not hand you a windfall. For most Australians, the changes produce between $13 and $47 extra in take-home pay per week. That is real, but it is not transformative. What the 2026 budget did do is shift the settings on a machine you are already inside, whether you understand it or not. And the people who understand the machine, who adjust their salary sacrifice to reflect the new concessional cap, who get their WFH records in order, who make a deliberate decision about private health rather than defaulting to whatever they did last year, those people will end up materially better off than the people who do not. Not because the system rewards effort, because the system is indifferent. It takes exactly what it is entitled to take from people who do not pay attention, and it leaves exactly what remains for people who do. So here is what I want you to actually do after watching this. Look at your current salary and find your marginal tax rate under the new brackets. If you are between $120,000 and $145,000, your marginal rate on that band has just dropped by 4.5 percentage points. That changes the math on salary sacrifice. Run the numbers. Find out if your employer has updated their pay withholding tables. If your pay slip has not changed at all, your employer may not have updated yet. You will get the benefit in your tax return if not in your pay slip, but you should know which one to expect. Check your super balance. If it is below $500,000, check how many years of unused concessional cap you have available to carry forward. The 2026 cap is $32,500. If you maxed it in previous years, that is fine. If you did not, calculate the carry forward available. If you work from home any proportion of the time, start a log today, not retroactively. Today, an hour here, 3 hours there, whatever is accurate. You need this for a legitimate claim. If your income is near the $97,000 Medicare Levy Surcharge threshold, do the private health insurance calculation, not the lazy version where you just assume insurance is cheaper. The actual version using a real quote for your age and state compared to the actual surcharge at your income level. Make a deliberate choice. And if you have an investment property, make sure your loan split is correct. Your interest deductions reflect only the investment component, and you have documentation for every claim you intend to make. The ATO's compliance activity in 2026 is targeted and funded. Being right is not enough. Being documentable is what matters. Somewhere right now, someone with the same income as you is going to file their 2026 tax return and get back $600 more than you. Not because they earned differently, not because they had a better accountant. Because they understood what changed, they kept the records. And they made the adjustments that the changes made available. The 2026 federal budget changed the tax settings that govern your financial life. Whether those changes benefit you or just pass you by is not a question of luck or income or circumstance. It is a question of whether you understand the machine you are living inside. Now you do.